Good morning. I'm Seth Rudin from International Business Associates, or IBA. I am joined here by the SBA lending extraordinaire.
Paul Long, Gisa Credit Union. Thanks for being here.
Glad to be here. We're here to educate and share our knowledge. And today we're going to talk about locked in, how collateral shapes your financing fate. It's a really important subject. If you want to get your prize acquisition, you're buying a business, and you don't bring the right collateral, Paul and or his peers are not going to approve. So in this video, you're going to hear what you need to consider and what's important to make sure you get through that and know what the concerns are of an SBA banker. Paul,
Yes.
what is the difference in the assets versus allocations? Is it really fair?
Oh my gosh, anytime I hear the word fair market value, I laugh at the word fair because it's never fair because there's each side of the transaction has a vested interest. So allocations, whether it's mostly on an asset sale, of course, but when you're selling a business, the value of the assets based on the seller and based on the buyer, everyone's going to want it either higher or lower based on their side. So coming up with that number as soon as possible is going to be really important for the collateral of the loan, because banks,
So
even
the
though
tax allocation of the purchase price.
Yeah, exactly.
With your
And
CPA.
Exactly. And again, we're not CPAs or attorneys, so make sure you do that to talk with them. But definitely having that conversation sooner than later is going to be absolutely important.
So the scenario is our tax allocations are negotiated. Maybe for whatever reason it comes in lower, but the bank also might view the equipment as either higher or lower than the endpoint, and you'd still underwrite that deal if you felt that the
Absolutely.
equipment was equal or more to the tax allocation.
Absolutely. Yep. Because we got to see where our collateral lies. Yep.
Very good. And is AR important as collateral to you?
It depends if you're a restaurant and you have accounts receivable, I would have lots of questions for you. But for the most of like manufacturing businesses or service-based businesses where you do have the accounts receivable, lenders are definitely going to want to see an accounts receivable aging report and an accounts payable aging report. And we're going to take a look at that, and we're going to look for concentrations. We're going to look for dollar amounts. We're going to look for what kind of clients you have. Do you have any concentrations? The thing that always scares me the most is when I see an accounts receivable and there's only one person on it. But again, there are some cases where, let's say, for example, that's Boeing. Okay, well, that's probably a little bit better than Billy Bob's Plumbing, right? Like there's a difference. So accounts receivable, we're going to want to take a look at that and make sure that they're valued appropriately.
And then older buckets are probably of concern, I would imagine.
Oh, yes. Thank you. That's a big one. Anything over 90 days, if you're in the construction field, you may have retentions and those are handled differently. But if you if you have stale things in your accounts receivable, make sure your QuickBooks is updated before you give us that report. And most importantly, make sure it's accurate, please.
And the contracts may say that the payment terms are 90 days. And in that case, the bank's probably fine with it as long as you have the working capital, right? Those are
exactly absolutely
to get around that.
Exactly.
But if you have 30 days and you got a bunch of 120, then there's probably some bad collection processes or some really poor ethical customers doing business with you.
Absolutely. Those are all things we look at.
Help me understand what happens in this whole collateral world if things don't go well.
Oh, geez. Well, we love equity in a home. I always tell people I have never met a lender that doesn't want to take the house as collateral. Okay, whether it's SBA, conventional, etc. Having that house shows us as the lender that you're putting skin in the game with cash, and skin in the game with your assets. And so that's always sometimes a nice arm wrestling session that happens in these. But SBA has some specific rules when it comes to this. If you have less than 25% equity in your home, it does not have to be taken. However, sometimes the lender may take it anyways, but that is one of the rules on SBA. Loans under 350,000, there's certain rules on whether the home gets taken or not based on how you read a specific sentence in the SOP, and depending on the loan program. So that's another important thing to have that conversation with your lender as soon as possible. Um, and I got to share this story. If you're going to be buying, and a lot of us who are watching this video has bought a house at some point, and the mortgage broker always says, don't pull credit, don't do anything until you have until this is closed, then you can, buy your car or buy whatever you wanted to do. I had someone buying a house in the middle of a business acquisition transaction. Oh my God. Oh, and not to mention buying it cash. So there's many things that go off on there. And so, when something like that happens, if there's more than 25% equity and there's a collateral shortfall, we got to take the house, right? So we had to take his current house and the house he's buying. And so that was definitely a lot of confusion. So be very careful about that because the lender is definitely going to want to understand that on the house.
It's too bad.
Yeah, I know it happens. Yep. A few other things that are also just as important as collateral, but not necessarily collateral, and that's post-closing liquidity. That is something if you don't hear those words from your lender, that scares me because we want to make sure that you're not, if you have $100,000 in your checking account for your down payment, and we see you only have $100,000 after you give your down payment or your equity, and you have no money left to live, that gives us heart issues as a lender because we want to make sure that you have some sort of post-closing liquidity. Even if it's like 3%, 5%, 20% of the loan amount, we want to see that if there is something that happens in the business after closing, are you coming back to us with your hand out asking, oh, bail me out, I need more money for this? Or are you putting in some personal assets to kind of get over that hump? So that's very important.
So a buyer wants to make a down payment and he's got 300,000 in cash and he's got 500,000 in his 401k and he needs to put down 250 or 280 as a down payment. He could use his Robs with the Guidant or somebody,
yes,
right?
Absolutely. Yep. Robs is a great program for that to kind of diversify your cash assets and what you're doing. So yeah, love Rob's programs. They are great. But when we're looking at cash and you're not doing a Robs, we don't necessarily count your 401k as being liquid because you get hit with a tax penalty based on your age, right? And so that's something you got to be really careful with on there.
Very good. This is going to be very helpful for a buyer and how they approach, I would imagine. This is a
Absolutely.
video they all should watch.
That's right. I hope so. All of our videos are important, Seth.
Yes, absolutely. Let's watch them all.
That's right.
Thank you, everybody, for taking the time. If you need to finance an acquisition, get cash for liquidity, line of credit, and any other commercial banking activity, obviously Paul is your man and Gisa Bank. And if you need to sell your business in either Washington or Oregon, IBA and myself, Seth Rudin, are here. I'm happy to introduce you to Paul, obviously. Thank you very much.
See you later.